Hello, everybody, and welcome to the AMA session on fundraising. Thank you, Step Forward, for the invitation. I'm Ciprian Borodescu, ex-founder and CEO at Morphle, a Romanian AI startup and Techstars alumni that got acquired by Algolia at the beginning of this year. I'm now head of Algolia Romania, AI evangelist, and in my spare time, I'm hosting a podcast called Get Your AI On, where I invite founders, entrepreneurs, business leaders, and even AI researchers to share their experience in dealing with business problems that can be solved through intelligent use of data. For those of you who don't know, Algolia is an AI-powered search and discovery platform that enables companies of all sizes to deliver fast and relevant digital experiences that drive real results. And today we have over 10,000 customers, a community of over 400,000 developers worldwide, and we're powering more than 1.5 trillion searches conducted on the Algolia platform annually, which makes us 4 times bigger than Bing, Yahoo, DuckDuckGo, Baidu, and Yandex combined. And when I joined Algolia at the beginning of this year, the headcount was around 350 people. We're now closer to 500 in less than 6 months, and it's amazing to witness and contribute to this kind of growth. Now, the reason I'm here answering your questions on fundraising is that I have about 15 years of experience as a founder and entrepreneur, and I would say that the last 5 were more intense and more fruitful with regards to my interaction with accelerators, angels, VCs, and other types of funding avenues, if you will, including grants. I have failed a couple of times with previous startups before growing Morphle and selling it to Algolia, at which point we were funded through Google Digital News Innovation Fund, European Data Incubator, and Techstars alumni, and we were in a very advanced process of raising our seed round of up to 1 million euros last year. Luckily for us, we ended up turning down a few investors due to the Algolia acquisition. That's kind of like the intro about me. Now I think we can jump to the questions. So we have here the first question: what's the best time to raise money? Is there a way to time fundraising correctly? Okay, so a couple of things here. First, you need to figure out if that's what you want to do, and do it. There's no middle ground. You either raise money or you don't. Once that decision has been made, the best time to raise money is before you need it. And the reason for that is that depending on your stage, it will take you 3 to 6 months until you can actually close an investment round and see the money in the bank. And fundraising is one of those things that you better not take it lightly, and you definitely get out of it what you put in, and it's a full-time job. Now, to share from my experience, last year I talked to over 50 investors, 50, before having a few that actually committed real money. And so it takes time, patience, and resilience. And so if you are listening to this, you better get cracking on. And here's another thing, which you probably heard. There's a lot of money to be invested out there. For sure, this is something that I've been hearing even during the pandemic last year. Be careful, though. That doesn't mean that VCs are throwing away money, nor that you should simply take money from just about anyone. Kind of like that's the things that I can say about that question. The next one: how much should you raise? Okay, first of all, I love this question, so thank you for that. This is one of those first things a good accelerator will teach you. Certainly, this was the case for us with Techstars. And what we learned from Techstars, but also from experience, contrary to popular belief, you do not raise the amount of money that you've calculated in an Excel sheet. No, you're actually raising as much as possible or as little as possible, depending on your capability as a founder, as a CEO, because most of the times the CEO is at the forefront of raising the money, depending on your network and the FOMO, fear of missing out, you're able to create, to generate, which let me tell you right now is something that is 100% real amongst investors of any size. And just to give you again a personal example, last year when we were raising 1 million euro, most of the investors we were talking with were asking, why do you need that much money? How are you going to spend that, and where would that lead you? Of course, I had the numbers to back it up, but I also had a plan B, which required less money, and of course, it was a less ambitious plan. I also had a plan C, and so on. Now, this was also a good way and a good conversation for me to filter out the unambitious investors versus those that actually understood what we were doing. And it was a really, really good and interesting way, even for me as an entrepreneur and founder, to filter out investors that just wanted to get a cheap deal. One thing is for sure, if you do not know what to do with the money, that's a big problem. And I've seen entrepreneurs that don't know what to do with $100,000, while others on the other extreme believe that they can do a lot more with $100,000. You always have to do your homework. I think that's the best way I can answer this question on how much you need to raise. Okay. The next one would be, what types of investors should entrepreneurs target at various stages? Angel investors, VCs, grants, accelerators, and so on. Well, yeah, it depends on the size of the company. If you are just starting up from an idea on a piece of paper and you have the right network, angel investment is a good route. If you do not want to give away equity, grants are another option. Then after getting a little bit of traction, accelerators are, in my opinion, a must for any respectful startup out there, because it opens up your opportunities and challenges, and challenges you and your team, besides getting a bit of cash. The cash is not that big, but it's clearly the value is in the network of the mentors and the opportunity that you have post acceleration. Then while you're going through the accelerator and growing your client base or user base, I would already start conversations with VCs. And I think all accelerators give entrepreneurs this kind of exposure to angels, to VCs, and so on. And of course, and one of the things that by now, if you follow this AMA, you understand, it's not like accelerators are waiting for you to be ready after 3 months, after 4 months, or 6 months. They actually expose you to those VCs and angel investors before you need to raise money. And of course, after you raise the pre-seed or seed round comes, Series A, B, C, and all of that. The play over there is a little bit different. It's a numbers game, and we won't cover it today. But it's safe to say that most of the time, you need a product market fit to get to that point or be close to getting it, or having a unique technology that compensates for that if you want to get to Series A, B, C, and so on. So yeah, these are kind of like the type of investors that early stage startups can approach. We have another question here. For pre-seed deals, what is the best way to find out the valuation of your company, and typically how many shares should you give at this stage? Same question for a seed round. Well, I think both for pre-seed and seed, it's kind of like the same thing. It depends on the geography. Pre-seed might mean less than $1 million in US. Clearly, in Romania, pre-seed can mean below $250,000. But I would, before talking about equity, I would absolutely encourage any entrepreneur out there to use convertible notes or safes. And if you don't know what a convertible note or safe is, I would absolutely encourage you to Google for that. There are so many companies and respectful VCs that have published their term sheet with all of their terms, not just some. And those became industry best practices. And I'm referring here to the global ones and YC or Techstars. I know that in Romania, some of the rounds were made last year using convertible. Not much around safes, but definitely agreeing with your early stage investor that the valuation of the company is more objective at a later round, typically Series A. That's when professional money comes in to the company, and that's the most objective way of valuating a company. Not early stage. Basically it's a bet. But if I really have to put a number on that, I would say that anywhere between 5% or 10%, sometimes even 15% is decent for pre-seed or seed. But it really depends on the type of investor. Is that person or group coming in with just the money, or are they bringing in something else like experience, network? They're opening up other opportunities. Unfortunately, I've seen a lot of first-time entrepreneurs, especially in Romania, willing to give a lot of equity for valuations that are simply not fair, and they know that. And I think this creates bad practice within our ecosystem. But at the end of the day, it's also a negotiation, and the maturity of the entrepreneur matters a lot in these situations. And recognizing that you are worth more than what is being recognized by VCs. But yeah, that's kind of like my 2 cents on that. Acceptable equity percentage. Okay. What milestones does an entrepreneur need to hit after raising each round of capital? Okay, so there are a couple of things here. Usually the milestones are set together with the new investor that is coming in into the company as part of the agreement. But generally speaking, if you are at the pre-seed stage, then which is defined by concept idea stage as a maturity, you typically, let's say, and I'm talking here globally, not necessarily in Romania, but you can basically scale it down. You typically raise less than $1 million. And the valuation, the typical valuation at pre-seed is about $1 to $3 million. When you have that, when you're at that stage, the goal is to actually go to the next one, which is seed. Of course, good startups and good founders, entrepreneurs, they can jump from pre-seed directly to Series A, and we have seen situations like that. But the next one is seed, and that's where you have an MVP. That's when you have a prototype, maybe a little bit of traction, and you typically raise between $1 million and $2 million dollars. And the valuation typically is between 3 to 10 million, something around that at the seed stage. Then for Series A onwards, we're talking about the product market fit. You are close to having product market fit, and then the round is 3 to 12 million, and the valuation can be up to 30 million, for example. And then starting with Series A, or the next one, Series B, Series C, and so on, and even going IPO, it's a totally different game. It's something that honestly I do not have experience at that stage. But it's important to understand pre-seed, seed, and Series A, I believe, in this AMA for early stage. Okay. Any other questions? What are the signs for getting the first commitment? Signs from the investors, I believe. So first, I would define what a commitment is. When talking to investors, you have to, as a founder, you really have to know your shit and understand that for them, for investors, showing an interest and meeting you for a coffee or accepting a Zoom call is not the same as signing a check. There's a very big difference in them being nice and being interested and actually committing. If they say something like, I'm interested, and they do not commit an amount of money, even verbally, they're just being nice. And what does a commitment mean? It means that they clearly articulate the amount of money they are willing to put in and under what conditions. If you do not have that, you do not have a commitment. Once you have that commitment, you can actually take that and convince other investors to join. I think this is one of those points where a lot of founders go wrong. And I also did a lot of mistakes like that until I actually went through Techstars and it was explained to me. And of course, this is something that I also felt last year when I was raising for Morphle. There was a lot of interest. Again, I met 50 investors. Everybody was interested. But having a commitment or getting to a commitment, getting a number out of their mouth was the most difficult thing until somebody actually said the magic words. One person. And then the entire game changed because I only needed, and it's usually like that, you only need one and the rest will follow. Not all of them, of course, but it's going to be easier to get from 1 to 2, 3 more investors than getting from 0 to 1. Some tips for startup founders with regard to the term sheet. Where do they need to pay more attention? What do you think about the option pool? Excellent questions, all three of them. Generally speaking, I wouldn't emphasize the conversation with an investor only on valuation and the amount of money that they put in. That's a conversation, sure, and it's part of the economical, let's say, aspect of the term sheet or of the conversation. But the other part, and you have a lot of provisions and a lot of terms in the term sheet and in the agreement that speak about the control of the company. Sometimes you have to give a board in your seat, a seat in your board as a company, sorry. Now you have to figure that one out. If you are at pre-seed or seed stage, it's not really that common to see or to give a seat in the board for that investor. Usually that comes at Series A. However, I've seen situations where investors are demanding a seat in the board, even as an observer. You have to figure out if you want to do that. Be careful with these terms, these control terms. Those are the most important ones, and I think, and this is one of the advice that we also got from our mentors and advisors, lawyer up. As a founder, it's absolutely impossible to know all of those terms in the agreement. It simply is. That's why you need lawyers. It's their job. And here's another thing: investors invest every day. This is their job. Your job is to actually grow the company. And of course, you do need to understand those terms to have a good intuition, but you need to have help. And so a lawyer can actually tell you step by step, term by term, what are you risking? What are the implications? There are situations where, and I've heard and I know about startups or founders that were in a situation where they wanted to sell the company, but the investors didn't agree. What do you do then? Or vice versa. The investors, because the terms allowed for that, were in a situation to force an exit on founders. What do you do then? If you signed this kind of agreement, which, by the way, is absolutely non-standard, but it happens, well, you kind of did it with your own hand, right? Nobody forced you to sign that kind of agreement. And I've seen founders and entrepreneurs that simply disregard these terms. The control terms are even more important than the economical terms. So yeah, and the last one, what do you think about the option pool? Yeah, 100% option pool is a must for any serious founder to have as a mindset for any serious startup. And I would say I have never seen investors that don't agree with that, or some of them are like, hey, you have to have an option pool. It's a sign of maturity, and it's common practice. Absolutely. Now, it's debatable what you want that option pool to be. Usually it's about 10%. It can be raised to 15% and so on. But I would absolutely encourage you to think about the option pool from day one, with or without investors. Okay, times is flying. We have one more question. How can entrepreneurs protect themselves and their teams from equity dilution when raising money at the early stage? Like, look, I mean, everybody dilutes when raising money from investors. That's the name of the game. If you don't want to do that, then maybe, depending on the stage you're at, grants are an option. But if you somehow manage to grow, and you still need to do that at speed, sooner or later you will need to seek professional money, which comes with dilution. And again, I want to emphasize this. Dilution is not such a scary thing, and I would not over-optimize here. I would pay more attention to the rest of the provisions in the agreement. Should you raise your first round in Romania, your own country, or can you look for investors from abroad as well? Yes and yes. You can raise money from both abroad and Romania if you can make that work. And there were some startups, and even we tried to do that, and we succeeded to a point. Be careful though. It's very complicated, because if you go abroad, you'll be in competition with startups, say, from UK. Yes, UK has more money, or US, whatever, has more money, but there's also more competition. And I think that unless you actually have the market and the traction abroad, I wouldn't bother. So I think it makes sense to raise money where your market is and where you have the traction. And ideally, if that's where you have your headquarters or the team, or at least one founder. Now, yes, we're living in a hybrid world. Things might have changed, but it's only common sense, right? Why would somebody from UK invest in a startup in Romania that is only selling to Romanian customers? Doesn't really make much sense. Again, it depends on the stage of the company. What is your best piece of advice for entrepreneurs about to raise a round? Okay, so it's not just one piece of advice. I think it's a few. So I think three things. First, decide why you want to do it. Is it because it's an ego play, or is it because you actually want to grow your business and your team and your product, and you have a plan to do it, not just a dream? So decide on why. That's number one. Why do you need money from investors? Second, do not underestimate it. It's a full-time job, and prepare to meet with tens of investors and be rejected constantly before getting to one yes. So you have to be resilient and get that first commitment. Now we know what a commitment is. And I promise you that if you get that first commitment, the game will change after that. And I guess the third advice would be, lawyer up and negotiate. It's kind of like it's 2 in 1. If you lawyer up, you are going to negotiate. If you have a lawyer and you do not negotiate, it's like, why even bother? So absolutely lawyer up and negotiate, because if you do not do it, for sure the investor will. And it's not going to be the lawyer that will negotiate for you. You are the owner of your own company, and you have to negotiate gracefully, but you still have to do it. Okay, I think the time is up. That's the entire time that we had for this MAA session on fundraising. Thanks a lot for having me. Step forward if you have any further questions or just want to bounce some ideas. You can reach out to me on LinkedIn or by email at chip@algolia.com. Yeah, keep on rocking, guys, and good luck with your fundraising. See you soon.